September 19, 2014 was a turning point in global tech history. A Chinese company most Americans barely knew stepped onto the New York Stock Exchange and instantly shattered records. Alibaba raised roughly $25 billion in the largest IPO the world had ever seen. Overnight, it wasn't just China's biggest internet company anymore. It became a global tech heavyweight. But here's the real question. More than a decade later, after regulations, competition, and economic slowdowns, how does Alibaba still generate over $130 billion a year? To understand Alibaba's money machine, you have to forget the idea that it's China's Amazon. Alibaba is not a traditional retailer. It doesn't rely on warehouses full of inventory or razor-thin margins on product sales. Instead, Alibaba built something far more powerful, an ecosystem where other people sell, advertise, ship, stream, pay, and compute, while Alibaba takes a cut at every step. The story begins in 1999, inside a small apartment in Hangzhou, where former English teacher Jack Ma and his co-founders launched a basic B2B website, connecting Chinese manufacturers with overseas buyers. At the time, China had fewer than 10 million internet users, online payments were rare, and trust in digital commerce was almost non-existent. Alibaba had to build not just a website, but the entire infrastructure around online trade. The company's first massive breakthrough came in 2003 with the launch of Taobao. When eBay entered China, Alibaba responded aggressively by creating a consumer-to-consumer marketplace tailored specifically for Chinese users. Taobao was free, fast, social, and deeply localized. Within 2 years, it dominated the market. eBay exited China shortly after. That victory laid the foundation for Alibaba as most important business, e-commerce platforms that don't sell products themselves, but enable millions of merchants to sell. Today, Alibaba's core revenue engine is still e-commerce, led by Taobao and Tmall. Together, they account for more than half of the company's total revenue. But the real genius lies in how Alibaba makes money from these platforms. Instead of charging customers, Alibaba primarily monetizes merchants through what it calls customer management revenue. That includes advertising fees, sales commissions, data services, and software tools that help sellers reach the right buyers. In simple terms, merchants pay Alibaba to be visible. The more competitive the marketplace becomes, the more valuable Alibaba's data and ad tools become. Recently, Alibaba introduced a small percentage-based software service fee that scales with sales volume. This move increased revenue from large sellers while lowering barriers for smaller ones, strengthening the ecosystem on both ends. It's a quiet change, but one that significantly boosts long-term profitability. Alibaba's reach doesn't stop at China. International platforms like AliExpress, Alibaba.com, Lazada, Daraz, and Trendyol extend its influence across Southeast Asia, South Asia, Europe, and emerging markets. While international commerce currently represents a smaller share of revenue, it's one of Alibaba's fastest-growing segments and a major long-term growth lever. Another powerful driver is logistics. Through its Cainiao network, Alibaba doesn't just move packages, it controls data, delivery speed, and efficiency across its platforms. Faster delivery increases customer satisfaction, which attracts more merchants, which increases advertising spend. Every part of the system feeds the next. Then there's Alibaba Cloud. While much smaller than Amazon Web Services globally, Alibaba Cloud dominates China's cloud market with over 1/3 market share. It powers everything from e-commerce traffic spikes to government systems and AI workloads. As China pushes aggressively into artificial intelligence, Alibaba Cloud has become a national strategic asset. AI models, enterprise software, and cloud subscriptions are now core pillars of Alibaba's future revenue. Of course, Alibaba's journey hasn't been smooth. In 2020, Chinese regulators launched a sweeping antitrust crackdown. Alibaba was fined nearly $3 billion, its stock collapsed, and investor confidence evaporated. At the same time, competitors like Pinduoduo, Temu, and TikTok commerce began reshaping how consumers shop faster, cheaper, and more entertainment-driven. In response, Alibaba attempted a radical restructuring in 2023, splitting into 6 independent business units. The idea was speed and flexibility, but the result was confusion. Just 2 years later, the company reversed course, reunifying the group under experienced leadership. Co-founders Zhou, Tsai, and Eddie Wu stepped in to stabilize operations and refocus the strategy. Today, Alibaba is back to basics, strengthening e-commerce while aggressively investing in cloud computing and AI. The result? Renewed growth, stronger margins, and a clear long-term vision. Alibaba is no longer just a shopping platform, it's infrastructure for the digital economy. And that's the real lesson behind how Alibaba makes billions. It doesn't chase trends, it builds systems. Systems that scale, adapt, and monetize activity rather than products. Whether consumers are shopping, streaming, advertising, or training AI models, Alibaba earns by enabling the ecosystem underneath it all. Jack Ma once said he wanted Alibaba to last at least 102 years. Long enough to exist across 3 centuries. Judging by how deeply Alibaba is embedded into global commerce and technology, that ambition might not be as unrealistic as it once sounded. If you found this breakdown valuable, make sure to like the video, subscribe for more deep dives into how the world's biggest companies really make money, and check out the next video on your screen, where we break down another global giant reshaping the future of finance and technology.